Rich Lowe, Pilot Legacy, on site at the Stanton, Lockhart, Texas, with our February 2023 investor update. Our January investor update was shot on the 27th of January. Recall that on that day I reported that the final arrangements were being completed for the carve-out of Phase 2 land from that of Phase 1. Well, I'm happy to report that on January 31st, the Phase 2 carve-out was executed according to plan for the final cost of $1.25 million. The purchase of the Phase 2 land constituted a partial release of the security interest Arbor Commercial Lending possesses on the Phase 1 portion of the project. That is, the original acreage in its totality, along with the existing 140 units on site. The carve-out has also served to reduce our monthly debt service under the current terms by several $1,000s each month, giving us some much-needed relief in that area. Investor equity was used to purchase the Phase 2 land away from Phase 1 and constitutes in part security for the Phase 2 construction loan, which is being provided by Encore Bank. And to that end, I'm also happy to report that on February 23rd, the Executive Loan Committee at Encore Bank gave its final approval for the Phase 2 construction loan and is standing by its commitment to provide $17.3 million in loan proceeds. We had hoped to have Phase 2 closed by now, but as you can well imagine, the list of administrative items and coordination involved with the carve-out and release from Arbor in New York to Encore Bank in Fort Worth, Texas, has just taken more time than everyone anticipated. In addition to the loan commitment letter, Encore indicated to us that it was prepared to close the construction loan within 10 days of that commitment letter. So as of today, we're looking at closing the construction loan around the 6th or 7th of March. So what about the Phase 1 refi? Recall that our current debt financing for Phase 1 is variable and based upon the 1-month LIBOR rate plus a 3.35% risk premium on $19.55 million. And also recall that in late January, the forward-looking LIBOR curve projected a 5% peak this coming June, which would place us at 8.35% on the loan with a debt service of just over $136,000 per month on the original loan amount. Based on those projections, our strategy was to carve out Phase 2 and refinance Phase 1 as quickly as possible with a fixed rate that would bring our monthly debt service down significantly. Arbor issued their preliminary term sheet to us on January 18th. Based upon the rising interest rates and increased risk in the debt markets, Arbor offered $15.86 million in proceeds with a fixed rate based upon the 10-year Treasury note plus a 1.7% risk premium. On January 18th, the 10-year was trading at 3.4%. And when we shot our last update on January 27th, the Treasury was trading at 3.5%. Well, on February 1st, the Federal Reserve Federal Open Market Committee raised rates another 25 basis points, bringing the federal funds rate to 4.5 to 4.75%, an increase that was generally regarded by most at the time as all but certain and presumed by most to likely be the last rate hike before pausing commenced in the spring. However, in the days following the meeting, news of the FOMC's ongoing concerns over continuing inflation became the predominant narrative, and that narrative was reflected in the bond market. Here you can see on February 3rd, the 10-year rate jumped nearly 4% in one day on the news, and since then it really hasn't looked back. It's been climbing unabated. On February 16th, the Producer Price Index rose 6% for the year ending in January, which was down from December's revised 6.5%, but it did jump 0.7% month over month from December, the largest month-on-month gain since last summer in June of 2022. Well, this was not the news that we wanted or needed. And in the wake of that news, Cleveland's Fed President Loretta Mester stated the following: "At this juncture, the incoming data have not changed my view that we will need to bring the federal funds rate above 5% and hold it there for some time. I saw a compelling economic case for a 50 basis point increase, which would have brought the top of the target range to 5%. With such hawkish remarks previewing an additional 25 basis point hike, the markets reacted accordingly. Here you can see the S&P, the Dow, the NASDAQ, and the Russell 2000 all took a nosedive following her comments, while Treasury yields continued steadily upward. But not to worry, the Fed's preferred indicator for evaluating inflation, the Personal Consumption Expenditures Index, which we previewed last month, was due out on February 24th, and it was expected to come in at 5%, cooler than what it was the previous month. Well, not only did PCE come in higher than expected at 5.4%, but the November and December numbers we covered in last month's update were revised upward 0.1 and 0.3% respectively. And you can bet that the January PCE will also be revised upward as well as more data comes in. The PCE print prompted St. Louis Fed President James Bullard to state the following: a more aggressive interest rate hike now would give the FOMC a better chance to bring down inflation, with Bullard advocating for a top rate of nearly 5.4% on the federal funds rate. So with that said, you can see the 10-year today is now trading around 3.9%, which would give us a 5.6% rate today, or a debt service of about $75,000 per month versus the $67,000 per month with the 10-year trading at 3.4% when we talked about that last month. So why haven't we locked our rate yet? Well, we're simply waiting for Arbor to finish its administrative to-do list following the execution of the Phase 2 carve-out. We couldn't lock right now if we wanted. Once Arbor gives us the green light in the same manner Encore Bank just did for the construction loan, we'll lock in the rate as well as the amount of the loan proceeds. With the forward curve projecting a decrease in the 10-year in the days and weeks ahead, should we wait? We don't believe so. The forward-looking curves are dynamic and change daily based on a myriad of economic and even geopolitical factors. Forward-looking rates for the summer are already about 60 basis points higher than they were this time last month, and that peak is delayed to the fall of 2023. The forward-looking rates are merely statistical predictions based upon the best data and prevailing sentiments at any given moment. Our biggest threat now is not so much 50 basis points more on the lending rate, but an additional cut in loan proceeds, which could occur at any time if something negative were to happen in the economy or around the world suddenly. Whether we close the construction loan first and then close the Phase 1 refi second, or vice versa, additional equity is required to complete the total funding package. We could either close the construction loan now and get Phase 2 underway and bring in additional equity for the Phase 1 refi, or if we were able to lock the Phase 1 refi rate today, we could do so and lower the debt service first and then bring in the additional equity to close the Phase 2 construction loan. But with inflation remaining somewhat entrenched and a 5.4% federal funds rate now looking more likely, we believe it's time to move where we can and as soon as we can. We're executing the construction loan first because the rate and the loan proceeds were locked by Encore Bank first on February 23rd, just a couple days ago. Meanwhile, we're still waiting on approval from Arbor to lock our rate and proceeds for the refi, which we're anticipating will occur by the first or second week in March. We've already had construction loan proceeds cut 3 times, and we don't want to delay and see that happen again. Keep in mind, regardless of which component is closed first, the extra equity being brought in is being utilized to refinance into a lower monthly debt service, thereby enhancing the financial performance of the project overall. The project is a go, that's not a problem. We're simply refinancing Phase 1 to improve the project's performance, and additional equity is required to shore up the capital stack where the lender is now more risk averse under the current environment. Although we're not yet moving dirt on site, a great deal of progress has been made since last month's update, and additional clarity on all the financial variables are finally coming into focus. I hope this gives you all a good feel for where we are and why. As soon as the loan proceeds and rates are established and the loans are closed with all equity partners and their membership interests known, we'll be able to present a clearer picture for you regarding the final capital stack, a detailed breakdown of sources and uses of funds, and updated return projections. We believe the biggest thing to keep in mind for the Stanton project is the overall basis we will have on 284 A-class units once Phase 2 is complete. A $200,000 per unit basis in an explosive market commanding $275,000 to $300,000 per unit right now is truly an exciting prospect in the present interest rate environment. So we want you to keep that in mind. This time next month, following an enjoyable spring break, we should be well underway on Phase 2 construction here at the Stanton. Regardless of which component is loan committee at Encore Bank gave its